This is the Rocket City Retirement Show with Cris Wallace. Cris loves educating people in person and over the airwaves. Whether it's retirement planning, investing, tax, or legacy, Cris prides himself in helping protect what matters to you. This is the Rocket City Retirement Show.
Hi, I'm Lou Ann Fulmer, and we welcome you to the Rocket City Retirement Show with certified financial planner and financial advisor Cris Wallace of WG Financial Group, where he is president. And then also joining us from the firm, Graham Bauer, who is a certified financial planner as well and a financial advisor at the firm. Both are here today to give us some really good advice about retirement planning. Now, some questions may arise today. If you have questions and you think, I need to go in and see them, well, guess what? You can. Complimentary, too. 256-937-2010. That's the way to reach out to get a complimentary appointment, meet with Cris. Again, 256-937-2010. You may call, but you can also text the word visit if you like to text. You can do it that way. Just text the word visit to the same number. And then remember, check us out on Facebook throughout the week. Just search for WG Financial Group 256. Any news headlines that may occur between now and the airing of this show, Cris will have updates on there. Anything related to retirement planning. And remember our motto: plan, retire, and play. That's what we want for you. And that's why we're going to give you some really good stuff today on our show. Find us online anytime at WGFinancialGroup.com. Our show also is available on Spotify or Apple Podcasts, wherever you get your podcasts. Just search for Rocket City Retirement Show. And Cris and Graham, hello to you.
Hey, Lou Ann, how are you doing?
Great, thanks.
Hey, Lou Ann, good to be talking with you today.
Yeah, I'm excited to be here with you. We have had a lot of stuff going on in the news, you guys. Oh my. Yeah. I'm kind of freaking out. I don't know about you, but with after Trump, gave his address to members of the Congress, wow, things have been just happening.
Yeah. Happening is probably an understatement.
Yeah.
I mean, there's so much that's going on. And I've talked to a lot of our internal clients and even prospects, and I would say people that even voted for him are now like not necessarily regretting their vote, but they are concerned that he's trying to do so much in so little time. Mm-hmm. And, this is not like gospel according to Cris, or maybe it is gospel according to Cris rather.
Maybe it is.
Typically every couple of years, Congress will turn over. And I think that's the concern right now is they're not working on a 2-year clock or a 4-year clock. They're working on a 2-year clock, in
True.
terms of, the Republicans control, both parties at this point. So I think that they feel in their mind they have to do a lot of these things. And he's real big on promises made and promises kept. So I think he's trying to do that and hold to his word. And he's trying to do it all really, really fast. And then the other thing that I think we have to think about, he's not running for like re-election.
Nope.
This is it for him. There's people in the Democratic Party that probably say, oh no, he's going to pass a law and stay in, the seat forever as president. Yeah. That's just not the case. This is it for him. It's basically 4 years and that's it. So, they're working on a 2-year clock in their minds, I think. And then the fact that, promises made, promises kept. See, we've heard that time and time again. And then also the fact that he's not running on re-election. But I don't know, Graham, have you heard from people that you've talked with personally, met with, that have kind of said, I'm a little concerned because they're going so fast?
Yeah. And I think it's a matter of just all the headlines that you see, no matter where you get your news, you're not going to miss a lot of the news happening right now because there's just so much stuff that's happening all the time that I think, even as someone in the industry, it's sometimes hard to even keep up with what's actually happening. Even if we're talking about something like tariffs, which ones are still in effect, which ones aren't, because the whole situation is so fluid. And if you have a full-time job and are doing meetings with people, or, you're an engineer and you're working on stuff all day, you don't have time to follow it. So we just see something here or there and we're like, whoa, there's a lot happening. So I think that there is some uncertainty there, but there's just a lot of uncertainty in general. And I think that really is kind of the theme of what's going on right now is just overall uncertainty. We know uncertainty creates volatility in the market, especially with retail investors, especially with your average investor. And, it can even be hard for me to be, sitting around being like, okay, I'm not gonna, I'm not going to go sell out of all my stock positions and because we had one bad day in the market. No, I'm holding strong on this one this time. So, I think that's what I hear most from people is that, there's just a level of uncertainty and probably just overall confusion about what's actually happening right now. Like what is driving everything, what's happening, what happened and then has stopped. Because like I said, the whole situation has just been so fluid. And we usually tell people, and this is true, that the president over, the long term is not the only thing that decides the stock market.
Yeah.
But in the short term, there can be big movements in, a couple day period. And obviously we've seen that here recently with, different things that have been said, tariffs that have been enacted and then, redacted. So I think that in this case, you could point to that maybe a little bit more as there being some volatility, but over a long time horizon, still, a tweet here or there is not going to be throwing the market off 10 years from now.
Right.
No, so what tariffs are still at play? They've basically, this is, China's getting this, Mexico's getting this, Canada's getting this, and then they change it. He changes it. Like
we're going to hold off. Yeah.
Yeah. He says one thing and then like 30 minutes later, a tweet goes out or something on Truth Social goes out and he's changed his mind and it causes the market to just go a little crazy. And I think this is, with Donald Trump, this is what you get. This is part of it. The tariffs in general, I think are obviously a way to raise revenue for the United States, but it's also, I believe, being used as a negotiation tool. And as we are recording, like literally it's this fluid. He raises the tariffs 50% on, I think it's aluminum to, coming from Canada. And then I think it's Ontario's or the new prime minister or whatever basically says, hey, we won't hesitate to shut electricity off.
Yeah, I heard that.
So now it's even gone further than just the tariffs. It's like, hey, we're going to cut off about 1.5 million people's electricity. So it's just really gotten a little crazy. And I think people, on both sides of the fence at this point are starting to go, man, this is a little bit more than I anticipated would happen.
I think so.
If you look at the market in general, Graham actually pointed this out. Like year to date, the market, is off like 5%. So you're like, oh, no big deal.
Right.
But pre-show, Graham and I were just kind of talking, and really off the highs, the S&P really, as we're recording, has entered into correction territory. So that's a 10% or more drop.
Right.
So, what are we seeing here? I think people are nervous. I think investors are nervous. I think hedge fund managers are nervous. But I think a lot of people have exited some of their equity positions just out of uncertainty and don't exactly know what's going to take place. And I want to say it was in first couple of weeks of January, I said we'll probably have a good 6 to 9 months of volatility because I think it's going to take us investors, just people in general, to kind of figure out exactly, okay, what is he going to do? He isn't Donald Trump. And what's going to work and what's not going to work. So, we may be in for a little bit of a bumpy ride, like a turbulence on an airplane, if you will.
I think it's started. I think it's definitely started. We have seen, a lot of things happen with the market here lately. Dow Jones and S&P 500, NASDAQ all took big hits. Let me play for you what Trump addressed to our members of Congress last week on his policy on tariffs, okay?
Okay.
Tariffs are about making America rich again and making America great again, and it's happening, and it will happen rather quickly. There'll be a little disturbance, but we're okay with that. It won't be much.
So everybody giggled when he said a little disturbance, and now here we are, 2 weeks later, and little disturbance is right.
So little disturbance is right. So I was just looking at the charts here as we're talking, and as I mentioned, the S&P, while we're recording, entered into correction territory. The NASDAQ is off more than 14% at this point. So it's already into correction territory.
Yep.
So definitely a little bit, it's probably an understatement, a little bit of a disturbance. I mean, 10% is defined as a correction, 20% is a bear market. Now, I get it that, that we should have a long-term outlook on, our investments and our retirement and all that. But if you've recently retired, this is very nerve-wracking to you. Because if you are on the right side and you say, well, I voted for Trump because I think he's going to run the country better. And now all of a sudden you're 1 or 2 months into retirement and it's like, oh, wait a minute, the market's off 10 and 15%, depending on what index you track the heaviest. It can be a little bit nerve-wracking. It can send that psychological impact that you have already going on with, hey, I've retired and now I don't have my job income, and oh no, the market's crashing, because that's what you think. It's like, where's the bottom? And this type of situation can cause you to make some very, very bad knee-jerk reaction decisions. It can cause you to go to cash. And I'll just remind you, if you've been in cash since like 2020, you've missed a ton of upside. There's been some volatility with the COVID. There was downturn in 22, but the market is significantly higher today than it was in 2020. So you just want to be careful. And this is why we do the show, and this is why we do what we do in terms of planning. You want to have a plan. You want to have a retirement plan in place. You want to know where your income's coming from. And you literally can't put all your faith in one person. Like you can't, because this kind of stuff will happen. So, I mean, I know you're hearing the same types of conversations, Graham, with people you're talking to as well.
Yeah. And, people can go back if they want and on Spotify and Apple Podcasts and listen to old radio shows. But we've kind of been saying this for a couple months now since the election that, right after the election, there was a big chunk of our client base that pretty immediately wanted to be a little bit more aggressive because, Trump is generally thought of as, more deregulatory, pro-business, and, overall, if you're just looking at the simple correlations there, you'd be like, oh yeah, the market should go crazy immediately. Mm-hmm. And what we've been kind of encouraging people is, if you want to be a little bit more aggressive and your overall plan allows for that, then that's okay. But you should not be jumping out of your risk tolerance just because of a president or a Congress or any one factor, because there's so many more things at play than just one factor when it comes to market movements. And you don't want to, be someone who is retired a month ago or retired 2 months ago and, was still all in the NASDAQ maybe and lost 15%, right off the top. Not saying that person couldn't still make it, but you don't want to be the person that just switched there because you're like, oh, rah, markets are going to go crazy immediately. And then you take a big loss early. Mm-hmm. So, it's really about managing your risk and mitigating it as much as possible, not just looking at one factor and, jumping in head first or, staying on the sidelines. So I think that, our messaging doesn't really change despite if it's a market correction or, if we have a plus 20% year like we've had in the last few years. But emotionally, I think people's responses certainly do change.
Yeah, they do. And this goes back to this kind of leads you into wanting to try to market time. President Trump gets elected in office and inaugurated, and it's like, okay, let's risk on. Well, I don't know. This is, this can be dangerous. And this is, again, why we kind of, say it's important to have a plan. So when we talk about tariffs, let's just talk about tariffs for a few minutes. What are they? And essentially it's a tax on imported goods, and it's going to make things a little bit more expensive, especially in the short run. So there's like a short-sighted view, and then there's the long view of this. Mm-hmm. The short-sighted view is it could drive up inflation because it's going to drive up the cost of goods. So as tariffs are enacted, then the cost of that good becomes more expensive. So, but the long-term impacts are that it raises money, and theoretically should allow for lower taxes. So you might be paying a little bit more for goods, but maybe some of that allows for some tax reduction. The other thing that it does is it can drive business back here to the United States. So if you're off, building something overseas, let's say, you're building widgets overseas and all of a sudden there's a 25% tariff slapped on that. Then from a business owner perspective, you got to start looking at, okay, well, if I'm taking into consideration the tariff, does it make more sense for me to start trying to build that widget back in the United States? Mm-hmm. Because it might actually be cheaper. And actually, maybe you don't have to get up at 1 o'clock in the morning and have a phone call with the Far East when it's, daytime over there and everybody else is sleeping over here. So I think there's some, the short-sighted view, and then there's the long-sighted view. I do agree with what Trump said as far as I can't remember exactly what he said just a few seconds ago, but it might be a little uncomfortable for a little bit, basically.
Yeah, a little disturbance.
A little disturbance, right?
For a bit.
So, yeah, 100% agree with that, because there's investors out there that will believe in this strategy, and then there are also some that don't believe in this strategy. So, there's all types of, I guess, data out there where people say, well, how will it impact your investments? And well, you're finding that out right now, because every time the T word comes out of his mouth, whether if it's I'm enforcing tariffs, you see the market drop. If it's I'm rolling them back, then you see the market, go up. And so there's been studies, and one of the studies that was done says that it could add $2,600 a year in expenses to the average household. Now, that's pretty big, especially if you're a retiree. You're talking $200 a month, and you're on a fixed income. That's a lot. So, again, points back to why we feel like people should have a plan. We feel like they should have a retirement income plan, understanding where their retirement money's coming from, so that they don't worry about these types of things here. And then also just make sure that your plan is built so that it can combat inflation. And that's essentially what this will be for, a little while. These tariffs can be inflationary in the short run. So I guess one of the things that I can, as we kind of talk through this, I'm just kind of thinking out loud here, is I would stay calm, because I think the tendency for a lot of people at this point is to get out of the market. And I think everybody listening to the show right now would understand and even agree with, in just a couple of days, this can turn around. I mean, it can be flipped right back around if there's agreements put in place, or tariffs are rolled back, or whatever the case may be. So you don't really realize the loss until you seal it by selling it. Once you sell it, it's sold and you sealed it. So our advice, again, and we said this like 14 times already in these first 17 minutes, is build yourself a plan, work with people that you can communicate with, and really to kind of be that consoler in a time where people are, just starting to struggle a little bit mentally, especially that new retiree. And that's kind of what we do. I mean, we provide a lot of information, a lot of communication, when things like this happen. But the biggest thing is building a plan, staying invested. I can't stress enough how much of a mistake a lot of people make by just going to cash. So anyway, those are kind of my thoughts on tariffs and kind of what's going on here. Luann, I thought you had another soundbite or something. I thought in the show notes I saw 2 sound bites for President Trump.
No, I only had one.
You only had one. Okay.
Yeah.
So
can I add one more thing here before we move on and just a little piece of data here too on market corrections versus bear markets. There's a good a chart that Schwab did on an article. Because the difference, just for people listening, between a market correction is generally, off 10% from the high, which we're pretty much there as of recording today with the S&P and are there with the NASDAQ. Then a bear market would be, more than 20% down from the high. So looking from 1974, there have been like 25 times where the market has been down more than 10 times and been labeled a correction. And only 5 of those times did it get to a bear market. So there were probably many other times where, the retail investor saw the 10% drop, got out of the market, and then it didn't turn into a bear market and turned around. And some of those times were in years that, I don't think people would have thought of as bad years, 2015, 2011, 1978. There's all these years that, are not known as years where the market was super bloody and horrible, but there were market corrections that happened in those years, but they didn't turn into bear markets. So it's another thing where, you're trying to time if there's going to be a bear market or if it's just a correction. You don't really know until you get there. But I guess if we're saying percentage wise, that's like what, 20% of the time or so. Yeah. So pretty low historically speaking.
Yeah. Again, I think just to kind of wrap this little segment up is, making those irrational decisions and just jumping out, not a great idea. You'll end up you might miss a little bit more of a drop, but you're going to miss a lot more of the bounce back, because we haven't said this in a while, but this is a great opportunity to bring it up, is when you get out of the market, you got to be right twice. You got to be right on when to get out, and then you got to be right on when to get back in. And getting out's kind of the easy part. That's the knee-jerk reaction. The getting back into the market is the hard part, because you're always going to have that in the back of your mind is, it's going to drop again. You're going to read an article. You're going to see something on Facebook or X, or you're going to watch a video on YouTube, and you're going to turn around. You're going to say, it's not time. It's not time to get back in. Next thing you know, you end up missing an entire year of just sitting on the sidelines. Meanwhile, the market continues to go up. So the best thing to do is build a plan and stay invested. And you have to treat your investments with a long-term outlook. Like the money's, you have to treat it with long-term, because if you go short-sighted with it, you're going to have a very, very unhappy retirement and probably an unhappy life, because you're just going to be steady stressed all the time.
So we have worked, so hard to save our money. We have what we have when we're in retirement. And so you guys are saying, we need to make sure we have a plan. Tell us what are some steps besides just that plan we can take to handle these challenges, this market volatility?
Yeah, I think one of the reasons this bothers a lot of people is the biggest fear, I think, for the retiree today is running out of money. I think that's well documented, but we're actually kind of in the camp of, okay, we understand it's a fear and a concern for many, many people today. And again, it's well documented, but the reality is most people won't run all the way out of money because they'll just slow down spending. So in a downturn situation like this, maybe you just don't go on that extra vacation maybe that you wanted to, or maybe you've planned appropriately and you have the money set aside for that vacation, or you're invested in a way where you can pull money out of a less volatile portfolio, or you have a source where you can withdraw from. So there's lifestyle changes that can be made, but it all revolves around having a plan in place. Did you make a good Social Security decision? Do you have a lot of Social Security income coming in to cover most of the necessary living expenses, or did you collect early and now you're 30% short on what you could have had if you'd waited till full retirement age? So I think there's, a lot of things that really point towards having the plan. Are your investments invested in a way that's not going to see a lot of volatility? And listen, if you're down like 2% right now, and I know you're probably, if you're listening, you're down 2%, you're worried about it. I get it. It's, my account's down too. Graham's is down too. We were talking about that pre-show, but just the markets are going to move. That's the message. Markets are going to move. And what you have to do, you have to be invested in a way that will allow you to move at the comfort level. So if the market's off 10% off the highs right now, because we mentioned we're kind of in that correction territory, and you're down 2%, you're down 20% of the market. That's actually not that bad. That would tell me you are probably mostly bonds at this point. And, bonds have been actually doing pretty decent as of late because the 10-year yield is dropping. So your bonds have actually gone up, and they've kind of done what they were supposed to do, which is kind of protect your portfolio in terms of volatility during a downturn. But again, if you're down 2-3%, that's not bad. That's like 3% of what the S&P is. And I would just encourage you to have faith in the plan, stick to it, and don't make any knee-jerk reactions.
Okay, so one thing you guys do is you help people come up with this plan for retirement. And Cris and Graham, you guys have the Rite Retirement process. Okay, and the Rite is an acronym, RITE. Retirement income, investments, taxes, and estate planning. So you guys help people create a plan to help retirees feel, more confident, about themselves getting into retirement and going through retirement no matter what happens. So tell us about what this looks like, because every week we say, hey, give us a call, go in for a discovery visit. Let's talk about that.
Yeah. So when we're working with someone new, we create what we call a report card, and we kind of have an income ratio score that we use. And typically we feel like if you can cover about 80% of your necessary living expenses with 80% of guaranteed income, so that would be Social Security, pension, or maybe some annuity income, that way you have the money coming in the household every single month, or bi-monthly or bi-weekly, however often you get paid. You have that money coming in almost like a paycheck. And when that happens and all of that income is coming into your household, you then can have a longer term outlook on your investments. So just picture yourself back in your 40s when you're working, you've got 20, 25 years to retirement in some cases, and you're like, I don't need my 401k. I'm just working and I'm just putting in, and you don't really care, or you didn't care at that time what the market was doing. Well, you can recreate that feeling just by making good decisions with your guaranteed income sources. So you can recreate that feeling by making a good Social Security decision, making a good pension decision. Because I have some people that have these pension lump sums, and they come to see me, and another advisor says, hey, we're going to take that lump sum because I'm going to make you more money. Well, how's that working out today for you?
Right.
Or if you listen to some other people on the radio and they say, you should take your Social Security and reinvest it at 62. Let me know how that's working out today, because it ain't very good. I can promise you that, because I'm watching the same market you are. So making good decisions on the guaranteed income piece is really solid. And we have some clients now. We don't do very many income annuities. It's just something we don't do a lot of. We'll do them from time to time when we feel like people need them. But in a situation like what's happening today, if you've got a pension, you've got Social Security, maybe you have a little bit of annuity income, and you don't have to pull out of your investments, then you're not worried today. You're not thinking about it, because you're like, hey, I've got all my bills paid. I've got my travel money taken care of. That money can ride. And that's the typical term that we'll use in the industry. When you're growing up, you just say, well, let it ride. Well, that's, you can recreate that feeling by making sure you have a solidified way to pull income out of a portfolio. So those are kind of my thoughts and how we go through it on the right income process. And then underneath the I, you've got investments. So we want to make sure you're invested in a way that you can handle it. Like right now, how are you feeling? Because if you were feeling a month ago when Trump was inaugurated, or what is it now, almost 6 weeks ago, if you were feeling like risk on, but today you're feeling not so great, that's your real risk tolerance. What you're feeling today is probably closer to your real risk tolerance than what you were feeling, say, 6 or 8, 10 weeks ago when he was actually elected, he being Trump. So under the investments, we want to make sure you're invested in a way that's comfortable for you. And then in taxes, like right now, and we'll talk about this in the second half of the show, there's some opportunity right now under the tax situation for a lot of people that they need to try to turn a negative into a positive. And then, of course, we've got the estate planning. So walking through that process, Luann, going through that report card, kind of walking through each element that we feel is very important to retirement can make you feel a little bit better, especially when you come in, sit down, have a conversation. Let's look at the big picture of things. I kind of liken it to like if I know there's been times, I can't think of anything right off the top of my head, where maybe I didn't feel good and I just wanted a doctor's opinion. And I was like, okay, I went to Google.
Oh dear.
And Google told me I was dying. I was going to die tomorrow.
Right.
And I just wanted to go talk to a doctor. And so sometimes coming in, sitting down, having a conversation with us, building out a plan, kind of partnering up, working with us can really just help you kind of feel like you're going to live a little bit longer instead of trying to find your answers on Google. So this is the first half of the show. It's been kind of fun so far. A little crazy stuff going on in the world today. But if you're listening to the first half, you're only catching 30 minutes. You can hop out to Apple Podcast or Spotify and catch the whole episode. If you'd like to come in and set up a discovery session, you can do that by calling 256-937-2010. Again, the number is 256-937-2010.
If you're pondering the longevity of your retirement savings with questions like, is my nest egg sufficient? Or how long will my retirement funds last? Consider scheduling a session with Cris Wallace. Text VISIT to 256-937-2010. Again, text VISIT to 256-937-2010 now to set up your appointment.
Quarters, just 25 cents. That's hardly anything, right? But Cris Wallace and his team at WG Financial see quarters a little differently. A quarter is a lot when it's a quarter of your retirement savings. Now, do you want to pay 25% or more in taxes during your retirement? Well, Cris can create a plan to help address that. Now, if the only time you think about taxes is when you file them, you don't have a tax strategy. But it's not too late to get one with the help from Cris Wallace. So act now to make sure you're not paying a quarter, dime, or even a penny more than you should. Call Cris Wallace and his team at WG Financial at 256-937-2010 to schedule your personalized tax strategy session. A quarter saved is a quarter earned. Call 256-937-2010 now. That's 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor. Firm may not give tax advice.
With so many worries in life, market volatility shouldn't be on your list. Help ensure your retirement plan is stable and independent of market swings. Just get in touch with Cris Wallace at 256-937-2010. That's 256-937-2010 to start planning.
And we thank you so much for spending part of your day with us today. This is the Rocket City Retirement Show. I'm Lou Ann Fulmer, along with my friend Cris Wallace, president of WG Financial Group. He is a certified financial planner, financial advisor, and Graham Bauer also with us today, another certified financial planner and a financial advisor at WG Financial Group. So excited to have you along. Remember, our motto is plan, retire, and play. That's what we want for you, our retirees who are listening, or if you're a pre-retiree. And, I just love what we're talking about today, even with all of this sort of uncertainty with the markets and everything. I think that what you're saying, Cris, is the theme is to remain calm. And Graham, you as well, remain calm and carry on, right?
That's it.
Yeah.
Plan, remain calm, and carry on. That's the message.
And then retire and play.
And then retire and play. Yeah.
Whatever.
But right now, if you're going out and you're trying to play right now, you're probably going out and you're thinking there's a tornado coming over the hilltops at this point.
Yes.
So, but yeah, that's, having the plan can kind of help you relax. So let's talk about some positives.
Okay.
Let's try to turn some
positives. Okay. During this downturn. Okay.
Yeah, a little WG positivity.
I love WG positivity. Okay.
Yeah, whole second half of the show.
Give us some, please.
Yeah. So, all right, let's talk about things that can be positive during this potential downturn or storm that we're seeing in the markets right now. So, as securities drop, there's a lot of things that can happen in different types of accounts. So, for starters, if you have a non-qualified, like a TOD or a joint with rights or survivorship account, this could be a potential opportunity for you to sell a security at a loss and potentially tax loss harvest, as we would call it. So you're going to purposely sell that security to gather the loss there, just to help you out on taxes. And so it's a purposeful sell that you would do. So that could be a positive, for your taxes. You can help yourself out a little bit and then turn around and reinvest the money a little bit later. So that would be one. Graham, I'll let you kind of take the second one we kind of talked about pre-show there.
Yeah. So, another one, obviously there's tax loss harvesting. Another one, I think what you're getting at is Roth conversions here, Cris. So, if you have a lot of pre-tax money, IRA money that you're going to have to take required minimum distributions on, it can be a good time to look at Roth conversions for a few reasons. For one reason, you're going to have a smaller account balance overall to convert. But I think the larger reason is that in all likelihood, your account will probably bounce back faster, recover a little bit quicker from the tax hit of a conversion if you're not paying it from outside sources, with, just going ahead and doing it during kind of a, more of a market correction, I guess we could say right now. So currently, if you have an IRA balance and you were going to take $100,000 and Roth convert it and, pay a little bit on taxes on that, once you're moving it to Roth status, if it, ends up recovering with the market and gets some growth, it's going to be moving into a tax-free status for all those gains going forward. So it can just be a good time to look at that. Sometimes people like to wait until the very end of the year to do a Roth conversion, which can make sense for some reasons, just making sure your tax picture for the year is all right. But, that doesn't always perfectly line up with, a good time in the market like it might right now.
Yeah, just to kind of piggyback on that, Graham, you do have to be careful with Roth conversions. And actually, let me breaking news interrupt as I'm sitting here.
Breaking news.
Ontario is suspending its 25% tariff on exports of electricity to Michigan, New York, and Minnesota.
Suspending.
So Trump wins, in other words.
Yeah.
And the market subsequently has shot up.
Oh, my word. There you go.
Today. So,
oh, my gosh.
Because it's so crazy to watch. Oh, my gosh.
It's so entertaining. See,
as we record that, it's just.
It's happening like right now as we're recording. So Really wild. Okay, so let's talk about the Roth conversion thing for a second. So you do have to be careful because if you convert, you can't undo it. So that's one of the key things that we have to note here. So a lot of times we're doing Roth conversions, not all the time, but towards the tail end of the year. And the reason for that is you want to make sure that you don't have any like unscheduled pulls that you have to pull from that might impact your adjusted gross income, which is what you're trying to stay under in a lot of cases for IRMA. So what you could consider doing, again, the market's off about 10% from the highs, as we noted earlier, is you could do a smaller partial conversion. So let's just say, for an example, you were going to convert, $100,000. Well, you could come in and maybe do $25,000, $30,000 today, and you're basically converting on sale. You're sliding that money over into a tax-free position in the future. So I just, that's an idea for some people that may be considering, well, I want to do it, but it may be a little bit too early. Well, you know what? Just do a little bit. Leave yourself some room in the bracket in case, the roof blows off or something like that. You got to pull 20 grand out of an IRA to put a new roof on or something along those lines. You could consider doing a smaller conversion there. On conversions, we are big advocates for being a little bit more aggressive with Roth money because it's growing tax-free in the future. So in other words, we don't think you should do Roth money and throw it into an annuity like that. That would be a bad idea in our opinion. We would want you to and encourage you to and show you the numbers behind why we think that money needs to be a little bit more aggressive. So I just kind of wanted to add that on the Roth conversion topic. You don't have to do it all today. You could do a little bit and then you could do another conversion like later in the year. So just something for you do-it-yourselfers out there who's listening to the show.
That's what Bobby and I are trying to do. We're 65 and 66. And so we are trying to do Roth conversions, as many as we can afford, but yeah. So I would say a little bit at a time.
You may not know the answer to this and it's okay if you don't, but I'm going to ask it anyway. But are you guys trying to stay in a certain tax bracket? Is that kind of what you're doing?
No.
Are you not sure?
Right now, you know what we're doing? We're just trying to put money in,
or in Roth.
Yeah, in a Roth for we're converting our IRAs to a Roth IRA so we can pull money out tax free. That's all we're thinking. Yeah.
Gotcha.
Yeah.
Okay. I didn't know if you knew if you were targeting, because some people like to stay in the 12 bracket. Yeah. Some people like to stay in the 22. Some people like to target underneath the first IRMA limit, which is just shy of the top of the 22. So I was just kind of curious what your thoughts were there.
Just tax-free money.
Tax-free money. Sounds great to me. Tax-free money. All right. Another item here that may be an opportunity. If you're sitting on a chunk of idle cash, now could be a potential opportunity to start putting some of that money to work that's been sitting idle. I kind of look at it this way. If you go into TJ Maxx, it's one of my favorite stores. I don't work for them. I don't get endorsed. I'm not endorsing them, but I love to go in there and just kind of shop if I've got time. And by shop, I mean dig, because that's what you have to do. You have to kind of dig through the clearance rack and to find the deal. So if I find a shirt that's like 20% off or something like that, I would be more inclined to buy it if it's 20% off. If I found a shirt that was 10% off, it'd have to be the right shirt for me to want to buy it at 10% off, because I think 10% off is a good savings, but it's not going to make me buy any shirt.
Right. I agree.
25%.
That's different.
I may be looking for a black shirt, but if I find a blue one that's 25% off, I'm probably going to buy the blue one and be okay with it. Yeah. So what I'm saying is, with the market being, 10% off at this point, you might have a couple of positions you may want to look at. You might just pick some ETFs. Matter of fact, I'd probably encourage that as opposed to trying to pick an individual stock, because I think it's really hard to do that. But just, buying an ETF, put some of that idle cash to work could be a potential opportunity at this point. Graham, there was another bullet point that we talked about as a potential positive during this downturn. And actually, you brought this up as I was making notes. I didn't even think about it. You kind of brought it up.
Just to make sure I'm on the right track, you're talking about interest rates.
Yes.
Okay. Yeah. I don't have we were just talking pre-show, and I was like, I should have written down all the points we were talking about.
I did.
Yeah. So this would be more of to be honest, maybe more of an opportunity for people who, maybe have a mortgage, or younger people in general. But, I think it's important to remember that though no one ever wants to go into a recession or a bear market or even market corrections, they can lend to, better interest rate environments, sometimes maybe a slightly lower inflation number coming in that kind of helps the feds to say, okay, maybe it's time to start cutting rates a little bit. So over time, if we have a little bit of a pullback here and maybe some of the economic firepower that has just been keeping us going for years now of this crazy consumer spending slows down a bit more, that could be kind of an opportunity. So I think that's probably something geared more towards, a retiree with a mortgage that they took out in like 2023 or 2024, or, a younger person looking to get their first home or looking to refinance a home that they took on. Cause I don't think anybody that got a mortgage between the years of like 2018 and 2021 really are maybe ever going to see a time to refinance for a lower rate in the rest of their life on really any debt that they got. But yeah, and speaking of, this is a tangent, but I got to bring this up because I thought this was crazy. I was talking to a mortgage lender the other day that goes to my church, and he mentioned to me that the lowest VA loan he ever saw back in 2021 was 1.75%.
Wow.
Oh, wow.
So, so rate environments like that, I don't think we're getting back to that anytime soon. But it could be a time to reposition some of those house loans, car loans, depending on what happens on a more macroeconomic scale.
Yeah. And I just kind of was looking at the 10-year treasury yield as Graham was talking, because we know, if you've been listening to the show long enough, we've kind of told you that the 10-year treasury or mortgage rates tend to follow the 10-year treasury, and there's usually about a 2.5% to 3% gap between what rates are and what the treasury yield is saying. And over the past 3 months, it looks like, actually it's less than 3 months, but back on looks like January the 13th, the 10-year yield topped out at 4.78. And currently, as we're recording here, it's at 4.28. So we've seen a 50 basis point drop in the 10-year yield since January the 13th. Now, what does that mean? Well, that's good for bonds. So if I were to pull up a chart and I were to overlay bonds from that period of time to current, then I would see bonds moving in a positive direction. And the longer the duration of that bond, the more return I will see from that bond. But the other thing that's good for the homeowner is, with that 10-year yield dropping as much as it has, it's also driven mortgage rates down. So during that same time frame, so right around January the 13th, mortgage rates have come down on average since January 16th. The highest that I see on one of my charts here was about 7%, like 7.04. And then the latest number that I'm looking at now is about 6.63. So we've seen about 0.4 drop in mortgage rates. So there comes a point where it's like, okay, I bought a house and I bought it at a 7.2% interest rate. And with this 10-year, if it continues to drop, then that could present an opportunity for potential refinancing. Mm-hmm. So it's just something that I think you want to keep a watch on. And if you want to watch, like, again, a measurable that you can watch is the 10-year yield. So when you see the 10-year yield dropping, then you can pretty much know that shortly thereafter, you're probably going to see mortgage rates start to drop as well. So just, in our opinion, those are kind of some positives that can happen in like these bad times. There's always good in everything bad. I mean, there's a silver lining, I guess, is the cliche that you hear quite a bit. So it's just a matter of not trying to be all doom and gloom and really just looking at opportunity. So sometimes losses can be opportunity.
Mm-hmm. Love it.
I want to move now, if we can, Lou Ann. I want to talk about a story and a situation. This is we have to be careful kind of how we talk about it, but we'll just call it a story. So we have, let's just say that we may or may not have met with a family that came in, and we've met with them now a couple times. And as we go through the process, again, our discovery session's pretty detailed, and we've refined it to where internally we feel like it's really stellar. I mean, if I'm being honest, and I'm not saying that in an arrogant way, we just feel like we uncover a whole lot of stuff. Like, a lot of people, even if they don't become a client of ours, leave the office and they're like, wow, we learned several things today. And that's great. That's what we want to. Yeah. We want the radio show to be educational. We want the do-it-yourselfer to pick up a couple nuggets and be able to do that. We want the show to also, bring us in people that need the help. They don't quite understand how to do everything, and maybe they don't want to do that. So let's just talk about a situation. So couple came in the office, and it is by far and away, it is the most complex situation I've ever seen.
Wow.
I've never, Graham shaking his head, because like we walked out of the office and we were like, wow, my head is spinning. And I said, hey, this is one of those cases you can talk about with your peers and stuff. And we actually told the client, we won't use your names on the radio, but this is going to be a radio story because it's a wild one. It's a doozy. So this family came in to see us, and they had a disabled child. Mm-hmm. We know that there's potential opportunity for Social Security, especially with a child that's disabled and under the age of, I believe it's 18. But you also have the ability, if they're under 16, to get some Social Security there as well. Okay. This particular gentleman, his wife had passed away.
Okay.
So the child was receiving survivor benefits from his late wife. Okay. He's now remarried. And then we find out that she also had a husband that passed away. Okay. So they were both widowed and widowed, essentially. Right. Yeah. They met and got married. And so we're going through their situation and talking with them and really trying to help them understand what they could potentially do to investigate to see if there's additional money that they could pull for their son on his behalf, just based on some disabilities that he does have. So in talking with them a little bit further and probing and asking a few more questions, we basically were able to kind of uncover with their help that they ended up getting married. I think it was him, Graham, who said that they married 51 days after he turned age 60.
Yeah, it was within a couple of months.
Yeah, it was so close. And why you're talking, well, why does that matter, Chris? Well, it matters because that opened up 2 additional windows, but we were able to uncover that they have a couple options here. So the options that this gentleman has, because his Social Security is pretty high, and if you've been listening to the show long enough, you know that we prefer that the higher income earner wait until at least full retirement age to collect Social Security. Well, because he's retiring, the individual has the opportunity to collect off his late wife. And he can collect off his late wife's Social Security and then defer his actually all the way until age 70.
Wow.
So it's a really stellar kind of move for him, because now he just hit the cutoff of age 60 because the age is important of remarriage. So he can collect hers and delay his. So that's one. Well, it's the exact opposite for his now wife. She was also a widow, and she was 60 when they remarried. So now she can collect hers for a couple more years, and she can defer her late husband's until her FRA, which is 67, right, which will give her substantially more income in retirement. So it's this doozy of a situation that just by asking a few more questions, we were able to kind of uncover some additional options. Now, I bring that up because we are, we're big fans and advocates of making sure that you make a really good Social Security decision because it's a large part of your income. But this is why when we're meeting with a family, we're trying to ask enough questions to make sure that we uncover all of the potential options that they have. And I know, Graham, I'm looking at you like when we left yesterday, we were like scratching our head going, this is crazy. Like it's the wildest situation we've ever dealt with.
Yeah, I mean, when you're talking about Social Security oddities and, different opportunities, the ones that would come up are divorced spouses, surviving spouses, children under the age of 16, disabled children, and, a spouse with a child under care under 16. And they checked every single one of those boxes except divorce.
Yeah.
Which, would have. So it adds all of these elements to it. And, it was actually a situation where just as we were going, things just kept popping into our head. And it was like, oh, well, actually, there's this too. And there's this too. So, it gets to a certain point where it remains to be seen what every amount maths out to based on, what the Social Security office gives them. But one thing I do just want to add on the collecting strategies and just kind of why that was sort of the way we talked about doing it. It is mainly because of the fact that, similar to how we usually talk about, deferring the higher amount, that's kind of what we're usually looking at too in a survivorship scenario, but it does depend on the situation. So, if the spouse, like in this situation, was only getting off her own record, $1,000 a month, and her deceased husband at, full retirement age would have been getting $3,000 a month, it's still probably going to be more advantageous to collect hers and defer his until only 67, because you can't push it further than that, instead of doing the opposite and collecting his and deferring hers till 70. She'll probably still end up with more. So it's really just a matter of doing that for how to just absolutely maximize how much you can get out of it. So I think, when we're going through the discovery process, some questions can sound a little invasive sometimes. Like, I've definitely been in situations where I'll, ask, a single divorce, a single individual come in and they'll be like, oh, I've been divorced. How many times have you been divorced? How long were you married to them? Are all of them still alive? And I usually like to say, I'm asking this for a reason. I promise. I'm not trying to get your, every detail about your life, but sometimes I like to joke and tell people, say, hey, well, if you have an ex-spouse, maybe just be friends with them on Facebook or something. Just check up every now and then, make sure they're still drawing a breath, because there could be some benefits there. Don't kill them. Definitely don't do that. But if something happens of natural causes, let us know. So it can sound like we're asking those for no reason, but it's because occasionally you hit a situation like this where it's just so complex, and if you miss one piece of it, there could be benefits that are missed out on.
Yeah. And I think the message here is thorough. Just being thorough with your conversation, being intentional with your questions. And it's awkward. And I totally can relate to how Graham just said sometimes. He's like, I promise I'm asking this for a reason. I've said almost verbatim the same thing.
Yeah, I'm not prying.
Yeah. And
we're never asked, why did it not work out or anything like
exactly.
that?
So can you tell me what happened?
What's the reason?
Yeah. Tell me how you feel. No, it's just so that we can make sure there's no opportunity there. And I think, I guess the word again would be thorough, but then the other word would be opportunity. And by being thorough, there are potentials where you can uncover, certain opportunities. So I just kind of want to talk for a few minutes on Social Security as we kind of talk the rest of the way through the show. Social Security, and Graham said this best, and I got to give him credit. Several months ago, he said that certain people want to treat it like a game. And I could not agree more with that comment, because that's the way I feel like a lot of people look at it. They look at it as on the spreadsheet, my break even is this, and I'm never going to live that long, and I want to get my money. It's going to go broke. And I just want to remind everybody some basic data here. About 20% of the world, or the world rather, not the world. Well, maybe, who knows?
World, yeah.
Doge may be finding some Social Security payments all over the world.
We know,
Yeah, I won't go down that rabbit hole right now. But about 20% of the U.S. population is on some form of Social Security. So whether that's widow's benefits, Social Security in general, disability benefits, it's about 20% of the United States is on Social Security. So I don't think it's going to go broke. I think that enough people are on it to where if they cut the benefit by like 25 or 30% or whatever they say it might be, that's a lot of people that's going to end up living on the street, not have a place to live, because for a large majority of the United States, Social Security is a large portion of a retiree's income. Or if you're on disability, it's probably all of your income in some cases. So when we talk about Social Security, make a solid decision, make a mathematical data decision, make a tax decision, because we know, just again, retraining, if we've got new listeners, Social Security is a very tax favorable asset in that the state of Alabama, Tennessee, several states, they do not tax Social Security benefits. So right off the bat, you don't pay any state tax on it. And only up to 85% of it is federally taxed. Okay, so now we've got an income stream that only 85% of it can be taxed, depending on our other sources of income. In some cases, if you just Social Security and you live in Alabama or Tennessee, you're in a zero tax bracket. You pay no taxes at all. So make a really good decision with Social Security, because it's more tax favorable. You're much more likely to have more net income. So make the tax decision, and then also make the spousal protection decision. So if you are a husband or wife, it doesn't matter, whoever the higher income earner is, if you collect early, you penalize yourself. You cut your benefit short by 30% if your full retirement age is at 67. So if you collect at 62, you've cut yourself short by 30%. You've also cut your spouse short as well. So we have to think about, Graham, I have to give you credit here too. I think you said something like Social Security is a 2-person decision or something like that. Do you remember saying that a couple weeks ago?
Maybe so. I don't know. I'll take the credit either way.
You say so much, you don't even remember it. You told me while we were getting our burger today, you said that people can regurgitate things that you said on the radio and you can't remember saying it. And I was like, yeah, me too. Yeah. Me too. We've done so many of these shows. So death benefit, taxes, Social Security is a two-person decision. So we really want to make sure that we preach that message, because Social Security is going to be a big part of your guaranteed income. Now, it's important also because Social Security receives a cost of living adjustment some years. I won't say all years, because we went through, what was it, like 2009 or something through 2020, 2021, where there were several years where there was really everything was flat, no COLA or very little COLA. Here recently with inflation, we've seen some pretty large increases on Social Security, but at the end of the day, it's COLA adjusted. And so you want to make a solid decision, because it's going to be a strong part of your guaranteed income, and it's also COLA adjusted as well. So I get it. People have to, but Chris, it doesn't keep up with the real inflation. I understand that, but it goes up. Even if it's 1%, 2%, or 3%, it's still better than most of the pensions that are out there that don't increase at all. So again, just make a solid decision with Social Security. And I think when people come in, that's some of the conversations that we're having. Now, we've been on the air. We have the longest running independent financial show in the Huntsville area. And we've been preaching this message for quite a while now. And it's been preached so much and for so long that most of the families that come in, if they've not collected Social Security, we don't have to have much of a conversation. Like if Graham's in the office, I'm not having to convince Graham, hey, Graham, you really should wait on your Social Security. Here's the reasons why. Most of the time, they're regurgitating that back to us. Mm-hmm. We can hear the undertones of what we've talked about on the show for years at this point. We've been on, what is it, Lou Ann, almost 9 years at this point? Mm-hmm. 9 years?
Yeah.
Can you believe it? You're 65 today, right?
Yes, I am.
I just called you out on the air.
Oh, I don't care. I say it all the time. Don't worry. Do not
you do.
worry.
And then you said Medicare eligible or something a few weeks ago or months ago.
Exactly.
Several times, I guess. Can you believe you were only, 56 when we started this?
Yeah, I know. I was 56, 57 when I started. Yeah. Yes.
And
I know. I mean, think of that.
Mm-hmm. That puts me at like 43, 44.
Look at you. You were just a baby.
I was about to say that. I was just a baby.
And then, Graham, where were you? No. No. We don't need to ask. It's okay.
Graham was carrying books.
Yes. Yes.
Carrying books and sharpening pencils.
That's right. Yeah, that's right.
For his schoolwork. Yeah. So anyway, it's kind of got me off topic.
Isn't that awesome?
there.
So,
yeah. So, as we wrap this up, it's been kind of a fun show towards the end of it. Try to get out of some of that doom and gloom. So there's some positivity out there on the tax side of things during this situation. If you missed most of the show, go back and listen to it. We think it's really good. There is some positives in the downturns. And then just make sure that you're making good decisions on Social Security. And if we can help you with your planning, we'd love to do that. All you got to do is give us a call at 256-937-2010. Again, our phone number is 256-937-2010. Hope everybody has an awesome and blessed week. And remember to serve every person in every situation with a servant heart.
A Roth conversion is a taxable event and may have several tax-related consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.
Investment advisory products and services made available through AE Wealth Management, LLC, a registered investment advisor. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by WG Insurance Services are not subject to investment advisor requirements. AWM and WG Insurance Services are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. WG Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial Group. This radio show is a paid placement.